Hello, my name is Nick Griffin. I'm the Head of International Strategy at K2 Asset Management, and this is the K2 International Third Quarter 2014 webinar. What we do here is we've done this a couple of times now, but we're basically just trying to provide you on a quarterly basis with an update on our view of the world, an update with our view on equity markets, and an update on the portfolio as to how it performed in the most recent quarter and how we think it's going to perform going forward. From that point of view, we are doing this as a recording this time rather than a live webinar because we found that most people just clicked on the recording last time. But from that point of view, don't be afraid to ask questions or contact your local K2 representative if you want any questions on anything that's provided in this document. It's essentially going to be only 20 minutes long, and it's meant to be brief, succinct update as to where we are. Just quickly, I'd just like to highlight the disclaimer. Obviously, everything we're giving you here is our view on the fund and where we think the fund should be positioned and where we think that should go forward, and is in no way investment advice for your own investments. The agenda is fairly simple. We're just going to go through the outlook for global growth, the outlook for equity markets within that outlook for global growth, an update on the portfolio as to how it performed during the quarter and why it performed the way it did and how we expect it to perform going forward, and then finally some conclusions. So just jumping straight into it, on the outlook for growth, we showed this slide a couple of times now, and I think it's just a simple way of showing that we've had a lot of stimulus put into the market. We're showing the US Federal Reserve assets as they build up over time, and we're showing US GDP expectations over the last 5 years. And as you can see, as the year goes on, we generally downgrade GDP expectations because despite all the stimulus we've had, we still are having a very, very slow and tepid recovery, and that's in the US. It's worse elsewhere in the world. On this particular slide, that's what we're trying to show you. This is the Global Purchasing Manager Indexes globally, and from that point of view, this is a survey for purchasing managers as to how they feel about expectations going forward. Over 50 is good, under 50 is bad, and obviously the direction over the last 6 months shows some deterioration, particularly in the Eurozone over here. And in the UK, emerging markets have stayed roughly flat, and the US has remained reasonably strong over the last 6 months. Showing that a different way from the last time we showed you the slide, we showed you that same slide 3 months ago, and as you can see on the right-hand side, there's been some fairly significant deterioration in the growth outlook in the Eurozone. Emerging markets are still bouncing along the bottom, so to speak, and the US on the left is still really the bastion of growth in the global economy as we see it at the moment. Why is the US still doing well? And that's mainly because they're adding jobs. On the right-hand side, there's 200,000 jobs roughly being added a month, which is a solid result. But if you look on the left-hand side, you'll see that the recovery in jobs back to the 2008 peak has taken longer in this recession than any other recession of the last 60 years. So while the US is recovering, it is recovering at a very slow rate. This is, as I suppose, the busy slide of the pack, and it's the one that's causing a lot of contention as we speak in markets, and it's known as the dots. The dots essentially show you the US Federal Reserve members are publishing every meeting their expectations of interest rates going forward, and each member here is represented by a dot. And so as you can see, the dots are moving slowly up between the meetings in the short term, and in the long term the dots are moving slightly lower. There's two things you should take away from this slide. One is that the Federal Reserve most members of the Federal Reserve, would like to raise interest rates at some point in the future. They feel that growth will be strong enough, and they feel they have the ability to raise rates. The second thing they obviously want to show you is they want this to be very, very clear to you that this is going to happen. This is probably the most well-telegraphed and well-flagged rate rise in the history of all time. And so from that point of view, we are in this unique period of communication. And if anything, the Fed is probably slowly getting themselves into a little knot here with how they communicate with the market, because they are providing so much transparency at this point in time. And as I said, the reason why this is important for markets, because markets are somewhat concerned about the removal of stimulus and the onset of rising rates, because that in itself may slow the economy, may slow growth, and obviously may slow earnings growth. Important to flag that there's a lot of divergence in the world at the moment. So this is just the forward rate curves in the US, England, the Europe and Japan, and as you can see, the Fed and the BOE have a fairly steep curve, i.e. the market still expects them to raise rates over the medium term, whereas in Europe and Japan there's really no sign of anybody raising rates anytime soon. And so from that point of view, we have this divergence. 18 months ago we had every central bank in the world on the same page. Now we have certain parts of the world doing well or better, and certain parts of the world still mired in a difficult period, and that's creating policy divergence and also creating volatility, particularly in exchange rates in the last quarter. The final slide to show on the outlook for growth, and I think this is the conundrum for the Fed, is that inflation is actually very weak. This is the US 2-year break-even inflation rate on the left and average hourly earnings on the right. And so if you were worried about inflation, then there is actually no reason to raise rates in the near term. And if anything, we have some deflationary influences in the marketplace, particularly and obviously in commodity prices, but also in places like Europe at the moment. So from that point of view, there is no pressure to raise rates, and we'll probably expect at some point the Fed may have to push out their rate rise expectations. Ultimately, if you raise rates for the right reasons, then that is ultimately bullish for equity markets. But in the short term, this is going to create some volatility, and that's what we're sort of seeing at the moment. Just in terms of the outlook for markets, so just to summarize on growth, I mean, obviously growth is probably worse, has deteriorated in the last quarter, particularly in the Eurozone. And from that point of view, that is somewhat disappointing, because we are probably looking at yet another year where most economies in the world are not managing to achieve exit velocity. And so the exit from stimulus and zero rates is unfortunately still seems at least a little way away, or further away depending on which region of the world you live in. In terms of markets, it's worth flagging here. This is the U.S. equity market. So on the right-hand side, we're showing you the S&P index, and you see that strong bull market from essentially March 2009 to today. And on the left-hand side, we are showing you the earnings of the S&P, which are the bars at the bottom here, and the forward PE of the market, which is the line at the top. And what you can see is that the market has essentially risen on the back of strong earnings growth and a re-rating. And so from that point of view, we now have the market essentially at fair value, which is just over 15 times earnings, but we still have earnings growth. Why is the market so concerned about rates? Well, firstly, because it creates uncertainty, because we're exiting a period of abnormal stimulus and no one, to be clear, really knows what's going to happen. And secondly, if we have that uncertainty, people are worried as what it will do to earnings, and also potentially what it does to the PE multiple of the market. And that's what's causing some of the volatility that we're seeing at the moment. Volatility aside, it is worth flagging that there is obviously still significant underpinning of this market from exceptionally low interest rates, and the US 10-year bond yield is still hovering in the low 2% level. And if you compare that to the US earnings yield, and we call this the equity carry, then you're getting a significant carry for owning equities. You're getting a better yield, you're getting a better earnings yield, and if you're running an equity company or a corporate that can borrow at investment grade rates, then your ability to invest and accrue even more growth to your equity account is quite high. So you can borrow money and invest in capex and earn a greater return than the 10-year bond rate and essentially create value. You can borrow money and buy back your stock and create value, and you can also borrow money and buy someone else's company, which will also create value. So all of those things are earnings accretive, and so from that point of view, there is this low interest rate environment is ultimately underpinning equities, and so that's ultimately why we're not actually that bearish over the medium term. Just in terms of the selected performance for the quarter, this just shows you what happened last quarter with all the various indices, and as you can see, a significant amount of volatility. Meager growth in the major indices around the world outside of Japan, and obviously significant negative performance from US small caps and emerging markets. From that point of view, on the right-hand side, the K2 Select International Absolute Return Fund produced 5.7% absolute return for the quarter, which was slightly above the index. Most of that return came from the weakness in the Aussie dollar, which thankfully we were unhedged. But ultimately, we were heartened to put together a positive return performance, and obviously one that slightly beat the index, albeit in a reasonably volatile environment. Looking ahead, we'd obviously intend or would like to improve on that. Just in terms of volatility, obviously there was volatilities in the indices over the quarter, and there was also volatility in currencies, particularly in other indices, but particularly in currencies. You can see the DXY was very strong for the quarter, and obviously versus the euro, the Aussie dollar, and the yen, as the US, obviously, as we flagged earlier, gets closer to trying to exit rates, and elsewhere in the world doesn't get close to exiting abnormal stimulus. So the US is closer to raising rates, and the rest of the world is still providing abnormal stimulus. The strong US dollar obviously affected commodities on the right hand side there, and we're showing you the weakness in oil in particular has been very profound, but also in copper and the CRB index. And on the bottom slide, obviously there's been this increase in volatility as the equity market takes account for the large movements in commodities and obviously the large movements in exchange rates, which is significantly affecting the earnings outlooks of many companies as we speak. Just a recap of a number of events during the quarter, and we'll let you read this in your own time. But from our point of view, the key highlights, I suppose, were the Alibaba IPO, which was a very successful IPO, came on at a 30% premium, and you'll see that we managed to get a small amount of stock in that IPO. And it has a distinction of being one of the few decent IPOs we've had this year. In M&A, we had Liberty Global acquiring a stake in ITV, which is exciting for us because we have ITV as a top 10 position. And we are seeing basically most of the dollars moving towards content. So we have essentially TV networks wanting to buy content, we have cable networks buying content, and we also have telecommunication networks wanting to buy content as they compete essentially for your dollars going forward. And so all the value seems to be accruing to the people who produce good content. In corporate news, we had, I suppose, the most interesting one was the Tesco profit warning. I think about their 5th profit warning. Staggering to see a supermarket, which is usually a stable business, essentially make such a mess of it in the UK with excess capacity, plenty of competition, and obviously very poor management. And from that point of view, a lot of people have got this one wrong. And it's surprising to see how much the retail network or landscape has changed in such a short amount of time that even supermarkets are now at risk. Policy announcement, the ECB provided more stimulus, and we suspect there's more to come. In terms of the market themes, we flagged most of these, but obviously currency was the big news of the quarter. And then finally at the bottom on geopolitics, I think the best thing we could say here is that the list is getting longer. There are some concerns there. None of them terminal from our point of view, but obviously some concerns nonetheless and worth keeping an eye on. Just a quick update on the portfolio. As you know, we have the 3 tools for adding value. The first one is obviously Alpha, which is trying to pick stocks that do well, and everybody will try and do that for you. The second is Variable Beta. And this is essentially whether we want to be in the market or out of the market at any point in time, and so we'll make that decision for you. And thirdly is the currency. Do we want to be hedged or unhedged the currency at any point in time? But with those 3 tools together, we think we give the best chance of providing absolute returns. I'm just going to take you through each tool and to how it's moved over time and how it's positioned for the quarter ahead. This is the net exposure of the fund since inception. As you can see, it can be as high as 100% exposed, or it can be as low as 40% exposed. I think over the last 18 months, we've made a very conscious effort to remain fully exposed across here with very little short exposure on the bottom, and we have started to ratchet that down as early as March, and we actually ended the quarter at roughly 80% invested because this is a 4-week rolling return. And so from that point of view, we are a little bit cautious markets because we feel that we are entering a period of volatility, and I suppose the first week of October has proved to be the case. But from that point of view, we see this volatility as an opportunity because we don't feel that the bull market ends with the first rate rise. Ultimately, if you raise rates, as we said, for the right reasons, that's good. And if unfortunately they are unable to raise rates, while that will be short-term positive, it is somewhat, I suppose, concerning from the point of view that we still 5 years on can't exit excess stimulus. But ultimately, both of these things should keep the long-term interest rates fairly well underpinned, and from that point of view, if the long-term interest rates remain underpinned, as we showed you earlier, then equities is still probably the place to be over the medium term. So short-term, a little bit concerned about the volatility, but ultimately we do expect to keep exposure reasonably high through this period, albeit not as high as it has been. In terms of currency, we continue to see downside risks for the Australian dollar. So as you can see here, it's exactly the same as the slide before. we have hedged the currency for a long period of time, and then we have slowly unhedged the currency. This has allowed us to protect absolute returns as the currency rose, and this has allowed us to pick up absolute returns as the currency fell. Important to note here, we didn't obviously drop the currency from 100 to 0 straight away. We did it over a 3-year period. And so from that point of view, while this was adding absolute returns as the currency fell, it did cause relative drag versus the index. But ultimately, this is an absolute return fund. We're here to make you money. And so from that point of view, we're not as concerned about losing relative performance versus the currency, because ultimately, yes, we would like to make money from the currency, but being 100% unhedged does expose you to risk of capital loss, whereas being hedged obviously negates your risk of capital loss in Aussie dollar terms. And so from that point of view, we don't unhedge lightly. We were thankfully fully unhedged for the quarter, which was heartening because we had been waiting for most of the year for the Aussie dollar to essentially crack. We showed you this slide last quarter, and it just shows you the US Aussie 10-year yield spread over time, over the last essentially 10 years. And so what the bond market's been telling you for some time is that growth prospects in the US are better than Australia, as Australian yields have come down and US yields have roughly held steady. But the currency was not reacting to that interest rate differential until recently, and finally we have seen the currency react. From that point of view, that was heartening because we've held this position for most of the year, and it has caused some pain or absolute return loss, which we've now recouped. But also, we would argue that there is probably still room for further weakness here. Strong US dollar markets or strong US dollar environments are generally not a 6-month thing. They generally run for 18 months to 3 years. And so from that point of view, we are going to remain unhedged the Aussie dollar. At some point, the Aussie dollar will fall to a point that we feel comfortable hedging again, or the risk reward is best to hedge it again. And from that point of view, we will be able to lock in the gains and then obviously protect against any rise in the Aussie dollar going forward, which will help us catch up some of that relative return that we've lost over the last couple of periods. But ultimately, from an absolute return perspective, once we hedged, you're essentially locked in from any loss or gain on the Australian dollar going forward. And at that point in time, we probably would be looking to do that in the low 80s at this point in time. Finally, just on the portfolio, on the stocks or the alpha, so to speak, these are the main positions in the funds and their performance for the quarter, or the main contributors to performance over the quarter. And all of this is in local dollar terms now, so we've stripped out the currency effects. And so from that point of view, it was heartening to see some of our top 10 positions do well. At the top of the page, disappointing obviously with the ones at the bottom of the page, and obviously regionally, as we said, there was a significant spread in the returns, and ultimately we didn't actually have that much money in the Eurozone, but the money we did have there we probably shouldn't have had there. And so from that point of view, we did get positive returns from the quarters from our stocks, but it was somewhat meagre versus the exchange rate gains that we made. So just finally on the top 10 holdings in the fund as we speak, ultimately, this hasn't changed much since we last spoke to you. The top 4 is still roughly the same. ITV, as we flagged, has been included over the quarter as a content investment. It's the UK's largest publicly listed television channel and has a large studio. They produce The X Factor and a number of other popular shows in the world. Disney is still a content play, as is Fox. The only other stocks added are Roche, which replaced Novartis, and essentially Swiss Pharmaceuticals, and Ashland, which is a US specialty chemical company. All of these stocks, as we flagged earlier, have contributed or not contributed to the performance over the last quarter, but ultimately we feel very strongly about all these positions. We feel strongly that they have solid non-cyclical earnings growth ahead of them, and we feel comfortable in the valuations. And so while the market is going through this period of volatility and many of these stocks are derating, ultimately they can't derate forever, and we do expect their share prices to eventually track their earnings forecasts, and their earnings forecasts, I have to admit, we feel very comfortable with. So from that point of view, we are comfortable with the stocks we're holding at this point in time, and as I said, even though there is some volatility, the earnings in the long run should play out. Finally, just to conclude, look, the September quarter 2014 was a positive quarter returns. We produced just over 5.5%. Absolute returns with gains on the Aussie dollar falling, driving most of that performance. In terms of our 3 tools on capital, 5 years into the bull market with rates, or the question of rates and the exit of stimulus on the horizon in the next 12 months, we do see the need for increased caution over the medium term. and we suspect that we're essentially trying to weigh up the period of caution versus a period which is traditionally quite strong in seasonal terms. And so from that point of view, we have raised a little bit of cash, but we haven't raised a lot of cash. And we expect to use that little bit of cash into any weakness. On foreign exchange, we remain unhedged, the Aussie dollar, versus most of our investments, but particularly our US dollar investments, and we look for the currency to continue to weaken over the medium term. Longer term, as we said, we have the ability to hedge the currency once the depreciation is complete. And then finally, on the stocks, we did achieve absolute returns on our investments during the quarter, but they were somewhat meagre in local currency terms. We clearly remain confident in the earnings growth of our investments, and as we said, while styles can re-rate and derate over any period, ultimately we believe share prices track earnings, and as I said, we're very confident in the earnings growth of the companies that we currently hold. Finally, just to conclude, if you have any questions on anything that I've come up with or said here, or you want to get in contact with a fund manager to go into further details of what we've just been through, then please don't be afraid to talk to any of these people. These are, of course, our business development managers, and they're here to help, and they will instantly get you contact with either myself or any of our colleagues. We appreciate you listening. We hope you enjoy this type of feedback or this type of insight into the fund, and please don't be afraid to provide any feedback. Thanks very much for your time, and hopefully see you all soon. Cheers.